Good evening and welcome to our webinar. It's just gone half past the hour, so we're going to get stuck right in. Thanks. Sorry for all the reminders. We just wanted to make sure that you were here and here on time because we've got some really good presenters this evening. Great topic and great time to be in and around finance and property with interest rates coming down for the first time in nearly 5 years. So really nice change for rates to come down. And tonight's webinar is about, right, this latest interest rate drop. Well, how's that going to affect the Australian property market? And we're going to be talking through that tonight. I want to do just an initial introduction. I will introduce them properly a little bit later on. And this is a bit like, it sounds like a bit like a joke. So I'm originally from Zimbabwe, but you've got a Zimbabwean, an American, and an Englishman. So let me go again. A Zimbabwean, American woman, and a Englishman walk into a pub. And what happens next, I don't know. But Dana, if you just wanted to say hello, just tell them whereabouts you're based. And yeah, where were you from originally?
Hi everyone. I am based in Perth. I'm originally from the New York area over in America. I've been in Australia since 2008, so quite a while. And I've been in the property industry nearly that entire time.
Thanks, Dana. Great to have you with us, and we will catch up with you a little bit later. And here's the Englishman, Andy. Just unmute yourself. Great to have you on this evening. Yeah, tell us where you're originally from and how long you've been in Australia.
Yeah, thanks, Garth. Actually, very similar to Dana. Moved here originally from the UK, Southampton. Moved here in 2008 and started my career in mortgage broking. So that's been 16 years ago now. So yeah, came to Perth. Yeah, it's very different now from when we moved here 16 years ago.
Well, it's a great place and it's a great country. So thanks, guys. We'll be introducing you shortly. We're going to get cracking on tonight's webinar. So let's get through to the first slide. We have some information for you tonight, and it is strictly general in nature when it comes to the finance or the property discussions or what our predictions are and what's happening in the market. So just a normal disclaimer with that. Please go and get your independent specific advice from the experts. Here we are. So some of you that may be new. So what do we do at Property Powerhouse? Well, we provide education, support, and experience to help mum and dad investors buy investment properties all around Australia, enabling them to retire wealthy and happy, ensuring them a financially free lifestyle in their retirement. And it's a real privilege to work in our industry, and when people say, well, what is it you most enjoy about your job? And we think, just like what Andy will say and what Dana will say, is we just like to help people become successful. Our business, I've been working in the industry now for 20 years, property investing industry. And our own business, Property Powerhouse, is almost 8 on Saturday. She turns 8, something we're really proud of. But being able to help people become more wealthy and do well through property, and that's been so strict with the property selections, literally saying, and on a rule of thumb, that would we sell that property to our mum, and if it passed that, there's obviously a lot of tests that go around in the background and due diligence, but we're only going to promote and recommend properties that we would sell to our own family. And we reject a lot of properties. Dana has works very, very hard at screening the right properties, and it's wonderful to help people and for them to do really well with their finances. So we'll help you buy the best investment properties. And the great thing is we have an Australia-wide footprint. We do concentrate on the capital cities, and we do that for a very good reason. They are the least risk areas that can withstand any sort of major changes to one or two industries. We're not going to be recommending you buy in a mining town or a tourism town or agriculture town or whatever that's too reliant on one or two industries. Those markets can do well, but they tend to be markets that you need to be a property trader. And what I mean by that is you need to be able to buy in and get out. Whereas property investing, the strategy we recommend is you buy and hold for 15 to 20 years, go to low risk areas, go to bed every night, put your head on the pillow. When you wake up, the property wouldn't have gone up dramatically, but it hasn't come down dramatically. It doesn't real estate, residential real estate is the transactions take a while, 2 to 3 months to go through. So there's no sort of panic sellings or panic sort of buying. So it's a much more low risk, consistent property investment vehicle. We work at no cost to the buyer, so that's fantastic. So some people say, "Oh gosh, and Dana, so you guys are buyer's agents." So in the broad scheme of things, the terminology, what we do would probably be yes, but we don't work at a cost to the buyer. If the property gets to settlement and values on contract price, we will get paid a fee by the vendor. In the 8 years of our business, I'm very proud to say that not one client has had to settle below bank valuation. And what does that mean? It means we make sure when we present the properties to our potential buyers, our clients, that we've done the due diligence and we know that that is at fair market price or cheaper. And we wouldn't present it unless we had the comparable sales and data to present that property. But none of the properties will settle value below the price we've managed to negotiate from the vendor. Fixed price contracts. So the great thing with that is there's no variables while a property is getting built. They want to add on. A lot of us around the country had experienced that where if they were going through house and land build times extended, land registrations were blown out, and builders started to put prices up. So none of our clients had to put prices up. We had to we negotiated really good terms with the builders that we use. We have good relationships, and none of those build prices were passed on. Very importantly, we give you long-term support and assistance. A normal real estate agent would hand you the keys and say, "Cheers, guys, good luck." It's a very, very important role of ours that I check in with the clients, or our team checks in with any buyers every 3 months, 6 months after purchase. How's the property going? Got any challenges? How's the property manager going? And generally, we've matched them the right property manager, and it's been a good journey for them. So I think we offer a fantastic service. We take a lot of pride in what we do, and it's a culture of excellence. So we try and deliver an excellent experience and excellent investment property. Right, let's have a quick look at the market update before we go to a little bit further. Just going to move my little Zoom stuff out the way so I can see what's going on. Right, so those of you who've been on before, you know I'm a great follower of CoreLogic. This table here is from CoreLogic. They are the residential property data specialists. They sort of in neutral ground. They're not controlled by any of the banks. They're independent. They report on all residential, and they do industrial reporting and business, commercial. But for our interest, we concentrate on the residential. Now, this chart will come out literally on the first day of every month. So the next one will come out the first working day. This will come out Monday next week, so Monday the 3rd. Even though the people in WA have got a public holiday, it'll still come out then. And it'll show all the data till the end of February. So I've used the latest chart that we've got from them, which was for the end of January. On the left-hand side, we have the property list. And when Tim Lawless was in Perth last week from CoreLogic, he did a presentation at the Urban Development Institute that I attended. I said to him, "Why is this in this particular order? Why is it not an alphabetical order or median value order?" And apparently it's just a sequence that's always been used by the Australian Bureau of Statistics. So I've been wondering myself what creates this particular order that run down the page. So that's just a little bit of arbitrary information, but I was very interested to find out what they do. So let's have a look at the right-hand side, and that is the median value. What does that mean? It means the middle price. So if 1,000 properties were sold that month, and let's say 10,000 properties were sold, let's say in Sydney in that month, they literally track the cheapest, which is your lowest, and then your most expensive, and they would find the 5,000th property in the middle to get to a median. It tends to be a better reading than giving an average, in case you had the average can throw off the numbers, but a median value. And as we can see on the right-hand side, let's have a look at this. So as expected, Sydney is tracking number 1, the most expensive. Number 2 is Brisbane. and that has really grown into a big brother now. It used to track around about maybe third or fourth. So we got Brisbane on the right-hand side. The numbers don't correlate brilliantly, but you're able to see that's number 2. Number 3 is Canberra. So Canberra quite expensive. All our sort of political people, I'm working for the government there. A lot of apartments there, and sitting number 3. Number 4, quite surprisingly, we got Adelaide there. Perth is sitting number 5. So even though Perth has had massive growth over the last year, relatively it's still quite well positioned versus the other capital cities. This is the big one, and we mentioned it last time we did a video in November, and we're going to talk about this in more detail later. Melbourne should be sitting at traditionally should be number 2 on the median value list. It should be number 2. It's suddenly sitting at number 6. Well, not suddenly, it's been there for a while. They've had no growth there over a period of the last sort of 4 to 5 years, and that is a buying signal. We're very, very bullish on Melbourne, and we'll talk about that a bit later. But it should be number 2, and it's number 6. All right. Number 7, we've got Hobart, and number 8, a little bit of skew there, is Darwin. All right. So that's medium values. If we have a look on the left-hand column here, which is under per month, let's see what happened in the month of January. The red arrows just showed you which markets went down in median values. The green one's up, and the yellow one is sideways. So we had 3 capital cities go down in median values: Sydney, Melbourne, and Canberra. That's a trend they've been tracking probably for the last year. The markets that have had growth, Brisbane, Adelaide, and Perth, particularly those have been very strong markets over the last 2 years. So not unexpected. And Darwin was sort of treading more like sort of going sideways, and now had a quite a strong run in this last month. Hobart just went sideways, no change in that. So the month by month doesn't tell you a big picture. It's more the quarterly that tells you, well, what's been happening in the last 3 months, and then what's been happening over the last year. And as we mentioned, in Perth, there's been a really strong growth, 17% in the last year, the last quarter 1%, and then 0.4. What that does show you is a trend line that is slowing. So Perth has been the strongest growth per month for the last 2 years. And this was the first month that we saw in 2 years where it actually wasn't the top performer. Top performer here for the last month was Adelaide, which has also been on a long run. But, and then I think second was Darwin, third was Perth, and then came Brisbane. What we're going to see starting to play out in the next couple of months is these cities now, the trend lines of growth will start to come together. What I mean by that is these interest rate drops that we're getting now is going to stimulate demand. It's going to stimulate some activity. And the markets which have been flat for a period of time, Melbourne for 4 to 5 years, and the Sydney the last few years, what we're going to start to see now is the rate of going negative per month. That's going to start to get to flat line at 0. And then we're going to start to see some growth coming out of Sydney and Melbourne as these interest rates drop. And we do think there will be, this is from Property Pass, we think there'll be another 2 drops this year. So as we start to get this momentum of dropping interest rates, we're going to see Sydney and Melbourne markets do a U-turn and start improving. Also, what we're seeing is the rate of growth out of Brisbane, Adelaide, and Perth are starting to slow. And what we'll see is there'll probably be some growth because the interest rate drops are going to fuel some demand for people that couldn't afford to get into the market. It'll also encourage some potentially upsizing, so people buying into the market and upsizing while they can. So I think what we're going to start to see now is probably on a month-by-month basis, probably a similar result across the board as Brisbane, Adelaide, Perth start to slow up. Maybe there'll be like 0.2s, 0.3s. We'll start seeing Sydney and Melbourne within a couple of months also showing 0.2, 0.3 growth. So it's a kind of cross-section of what's happening. The properties that weren't going well are going to turn, and the ones that were going well are probably just going to, well, not drop, but they're going to flatline. They're going to have a soft landing. That is the great thing with interest rates dropping, is there's going to be a soft landing when prices start to stabilize in Brisbane, Adelaide, and Perth. Right, I'm just mindful of my time. I've got 1 minute to go before I hand on. Interest rate drops. How we've already seen it dropping in the market, considering that was on the 18th of February. So what are we, not even sort of 10 days later, but talking talking to our clients, talking to our referral partners and finance brokers, there's definitely a lot more confidence in the room. Confidence for home buyers, home owners who've got mortgages, and also for investors. Uh, People are now more confident that interest rates are dropping, and there's really strong emphasis that and feeling that there's going to be another couple of interest rate drops this year. And generally, what I've learned from some smart people around finance is that the Reserve Bank doesn't tweak in single amounts. They don't, when rates are going up, they don't do one tweak only up increase and leave it alone. When they come down, they don't have interest rates come down. They don't have one tweak only and leave it there. They generally move in cycles of threes or fours. So when they're coming down, there's normally over a period of time, there's 3 drops or 4 drops. And when they're going up, there's 3 or 4. So what do we read into this at Property Powerhouse? We reckon we've had one drop, or we've had the one drop already, and we do anticipate another 2 drops coming this year. And we believe, all things being equal, some further drops next year, which is exciting news for people that have mortgages or looking to take on mortgages. Holding costs for investors have dropped and will continue to drop as interest rates come down. That's fantastic. It helps you with your cash flow. So your biggest outgoing as an investor is your mortgage. So if you've got a interest only, it really makes a difference, a chunk of difference. Even principal and interest, the interest component will help there. It increases purchasing capacities. So for investors or owner occupiers, and in the sense of what we hear tonight, investors, where you could maybe only buy for 500,000, you can buy for a little bit more now. And your holding costs as a purchaser where you couldn't qualify before, you might qualify now. People are more confident, more interested in talking to their finance brokers and their banks, which is excellent. So I'm going to pass on to the next speaker now, but I'm really excited about the market that we're in. So nice after nearly 5 years that we've got an interest rate dropping cycle, and you can just feel the weight coming a little bit off all of our shoulders. All right, the next speaker we're going to introduce is Andy Drake, and I'm going to ask Andy to unmute himself. I'm going to just give him an introduction. I know Andy from our business circles and networking, been around a lot of the finance and property events. A fantastic guy, very well respected in the industry. He's the AFG State Sales Manager. AFG are an aggregator, which is above brokers and just below the banks. Very important role they play. Andy is an experienced sales relationship manager with a demonstrated history of working in the financial services industry for over 16 years now. He's an ex-finance broker himself. He was in that role for 10 years, where he settled more than $400 million in loans. So very good operator, specializing in construction, finance, and management. He is passionate about the finance industry and takes great pride in helping finance brokers and businesses make informed choices. Nothing gives him greater pleasure than seeing people succeed. So good evening, Andy, and over to you.
There you go. Thanks for that introduction, and good evening to everyone again. Like Garth said, I'm passionate about this industry, the housing industry. I came into finance 16 years ago when I moved to Australia, and what I'm doing now at AFG is actually helping mortgage broking businesses and get them started and help them grow. So what we find is we sort of all move in the same circles, and what Garth's doing and what the brokers do and what the real estate agents do and the buyers agents, we all sort of interlink in some way, shape or form. So if you could flick to the next slide, please. So look, finance obviously is not the most exciting conversation, so I'm going to not speak for too long tonight, but happy to take any questions. What we're going to do is we just go. I've got a little bit of an agenda up there for you. So we're looking at the interest rates, how they've performed over the last 20 years, and then we'll have a quick look at what the best sort of rates are going around at the moment with investors, fixed and variable. Also, look, again, this in terms of my opinion, we don't have a crystal ball, but how the banks are going to respond to the recent rate drop, and if we, like Garth saying, predicting another 2 rate drops this year, how that might affect the finance demand and supply. Next slide, please. I find this graph quite interesting, having been in Perth for 16 years, and when you sort of obviously look at the rates, been up around 7%, which is pretty much when I moved to Australia, and I was told at that time that was a sort of normal interest rate for as a healthy property market. But it's interesting to see now where we talk about rates potentially being high in 2025 with a cash rate where it sits at the moment. If you actually draw a line across that sort of 4% mark, it actually represents quite a median or average rate. So the fact that we're sort of looking at rates coming off now, we sort of curbed the inflation and we're looking at rates sort of going down the other way is I think it's quite exciting for everyone who's involved in investing in property and homeowners. Next slide. So if you guys have got investment properties at the moment, I thought I'd just give you a little snapshot of some of the best interest rates which are out there and where rates are currently sitting. This is actually based on a 80% loan to value with borrowing of 500,000, and you can see there Bendigo Bank and ING are sort of all pretty similar around the 6.29% mark. Ranging from 6.3 up to 6.29. When you look on the right-hand side of the slide, it's interesting to notice that this is a snapshot that I took off a serviceability calculator yesterday, showing where the 2-year fixed rate interest or the 2-year fixed rates are sitting. And what you can see there, the correlation between the variables and then the 2-year fix, you actually see that the 5.84. So what we find with banks, and when we see these rate cycles of rates increasing and rates decreasing, banks tend to hedge because they're buying funding in for their fixed rates and then retailing it out at a certain amount of money to obviously try and make money on it. So they're sort of having when you see the fixed rates coming off, that's can indicate that we're looking to see further rate cuts. Again, this is my opinion in terms of what we're talking about. But as a general rule, when you see fixed rates lower than variable rates, there's a sure sign in where the market's headed. Similarly, when you're in an increasing market or increasing rate period, you'll generally see that the fixed rates are higher than the current variables because, again, the banks are hedging. So all I would suggest to you at the moment, guys, if you've got investment mortgages, speak to your brokers, make sure that you're on the best deal. Most banks have said that they're going to pass on the 0.25% reduction in the cash rate. But if your lender hasn't for any reason, or you think that you could get a better deal, then definitely contact your brokers, have a shop around, and see what you can get from the banks. Next slide, please. Okay, so I put this slide up there. It's a little bit busy, so it's sort of how we feel the banks will respond to the recent rate cut in the cash rate, which currently sits at 4.1%. So, like I said on the previous slide, banks reduced their lending rates for mortgages, personal loans, business loans to reflect the lower cash rate. And the advantage of that is what it does is it makes borrowing more attractive for consumers and businesses. Adjustments to saving rates is probably the negative with reducing rate cycle. Interest rates on saving accounts and term deposits might decrease, which could affect savers long term. Savers looking for higher returns in the long term. So that's also when you can see people have had money sat in term deposit. That's when they may start looking at they might have self-managed super funds. They may start looking to take some of that money out of their longer savings and then put that into property. I don't know, did you jumped on the screen there, Garth? Did you have a question, or you?
No, Matt, just really enjoying what you're saying there. Maybe just while we're there at the savings rate, so would we say that's kind of traditionally more the your retirees that are putting money in cash? They're the losers with interest rates coming down. Would that be fair to say?
That's exactly the case. If you speak to people who don't the losers in that situation are the ones who don't have mortgages. I certainly have mortgages, and I'm glad the rates are starting to come off a bit. I'm sure everyone who's got investment portfolios or even owner properties, we've been probably feeling the pinch a little bit over the last sort of couple of years. So there's always losers, but again, it's where they can sort of then maybe if it's sat in savings, where they can look to diversify those savings and put them into different areas, and some of those obviously being property. One thing with the banks as well, when they although they make billions of dollars in profit a year, the result of the RBA decreasing rates, the bank's profit margins could be squeezed. There's a difference between the interest they earn on loans and interest they pay on deposits narrows. And looking at a broader economic impact, the lower interest rates can boost consumer spending as people have more disposable income due to lower loan repayments. Now, I'm sure you're all aware this is the balancing act that the Reserve has at the moment with consumer spending and inflation. So that's why they've been pretty, I'd say, in my opinion, probably sort of delayed the rate cuts for a little bit just to make sure that inflationary pressure was out of the way. The rate cut signals that the RBA believes inflation is under control, which should see the economy stabilise, which we all think that's now in place, albeit that they did release the monthly inflation reports today and saying that the leveled or median inflation is up by 0.1%, but it's still actually within target. The Reserve generally only look at that on a quarterly basis rather than a monthly basis. But when they're looking at the inflation rate, generally they're stripping out or what they call leveling out, which is taking Christmas and that sort of stuff where spending would have been higher. So it's still at the higher end in terms of where inflation sits, but the fact that the rates are coming off, I think, is a positive, a positive move. Next slide, please, Garth.
Okay, give me 1 second, trying to get this to happen. Let me see. There we go.
So a bit of an outlook for 2025, if we have another 2 rate cuts and how this might affect investors. Now, again, I don't have a crystal ball. No one on this webinar has a crystal ball. They're saying that there could be another 2 rates. Again, it very much rate cuts. It very much depends on lots of different factors in terms of how the unemployment rates, the salary increases, what's going on in the rest of the world. But if, like we say, they're keeping this inflation under control, then I'm hoping, and then probably a lot of us are hoping, that we should see another 2 rate cuts before the end of the calendar year. In terms of how that, I guess, impacts on the market, finance, which is like your finance demand and supply market. Lower interest rates generally make borrowing cheaper, which can lead to an increase in demand for loans for both consumers and businesses. So, like Garth was saying earlier, when you have a 0.25% decrease, what it does is it enables people to be able to borrow more. And where we've seen, particularly in Perth, where we've seen sustained growth now for the last sort of 2 to 3 years, what we're finding is a lot of people start getting priced out of the market, because in finance, the APRA set they actually, with whatever your interest rate is, the loan has to be set with a 3% buffer. And what we're finding is where the rates have been higher, what they're doing is they're qualifying the people at 3% higher than what the actual rate is that they're getting. Now, when you've got a rising property market and like the median house price now in Perth, I think back to your slide, Garth, was about 800, and I think it was 850,000, something like that. The reduction in interest rates now is enabling those people who couldn't afford to maybe get that investment property or get that first home and then actually get into those homes. So what that can do is then accentuate the issue we have, which is the supply market, because there is a housing shortage in Perth, definitely. I'm from Perth, so I can't speak for the rest of Australia, but I imagine it would be the same. Where I'm just going to move. Sorry, guys, because I'm in the office and all the lights have gone off. But I hope you can still see me. So
Yes.
Look, this can stimulate the economic activity as more people take out loans, homes, car loans, and business investments. With lower borrowing costs, consumers may have more disposable income, leading to increased spending. This can boost demand for goods, services, potentially driving economic growth, which is also good. Investors, which we were talking about earlier, they might start looking at shifting their focus from fixed income securities, which offer lower returns in a low interest rate environment. So that's what we're talking about with term deposits, where they may see that, supply and demand with property, decreasing interest rates and increased yields. They're better off putting their money into property rather than having them sat in a term deposit, because they're making more on their return. And that's pretty much it from me, guys. Short and sweet. I don't like to go on too much about finance, because there's probably some more interesting stuff coming from Dana in terms of where the properties are. But happy to answer any questions, Garth, either now or at the end of the webinar.
No, that's wonderful. And just to our attendees, please, there is options on that. They should have a bar where you can ask questions or put into chat. So please, at any stage, put your questions or chat comments in there. I'll be trying to keep an eye on that while we're also trying to run the webinar. I find finance absolutely fascinating, because we know property does well in Australia. We know it's a good wealth creation exercise. If we could get access to more money and more borrowings, then we could build this portfolio of property. So finance and your finance broker need to be your best friend. Once you get the confidence in investing in property, it really comes down to how do I get more funds and more, how do I buy another property? I love property. It's been if it's been a good experience for you and you want to do more, it comes down to finance, and that's the thing. Do you have the equity? Do you have the serviceability? There'll be questions now and at the end. I've got two questions for you, Andy. The first one is, and this, guys, our webinars are always meant to be educational. So tonight we want to learn. Even if you learn one thing from the webinar, we've done well. I want to ask you about, what is cash rate? So we're talking about Reserve Bank set a cash rate of 4.1, but when we get our loans from the bank, like you spoke a bit earlier, like 5.3, or for investors, it might be 6 point something on a variable rates. What does a cash rate mean versus what we get when we go to the bank? And yeah, so just maybe explain the difference, and how does what does it actually mean, so we can understand as mum and dad investors.
Well, yeah, so the cash rate really is the rate that the Reserve Bank of Australia set in terms of where they see the interest rates or costs of borrowing. What you actually find in terms, and this is where the banks are buying funds in, and then they're retailing them out at a higher rate. So although you see the cash rate, which is currently set at 4.1%, that's never actually the rate that you're going to get, because the way the banks make money is they put a margin or an increased rate on top of the actual cash rate, and that's where they make their profits from. It's similar in the way how at AFG we have AFG Securities, so we actually have our own funding line as well. So we actually have what's called a warehouse. Now, with a warehouse, it's where we'll go and buy money, whether it's from overseas or off different banks, and that will get sold to us at a certain amount. So say it gets sold to us at 5%, and then the actual rate that we're retailing that out at might be 5.6. So we're making a 0.6% margin on that money over the term, but of a loan. So that, I don't know if that was a sufficient explanation for it without really going into the like detailed economics behind the difference between cash rate and cost of
That's
borrowing.
wonderful.
But yeah, that's essentially what it means. So we'd all love to have the actual cash rate as it was, but then yeah, the lending institutions wouldn't be making any money.
No, we'd had that for them not to earn their billions. But the other question I want us to understand, we understand what bankers, we know Westpac, we know Commonwealth Bank, ANZ, NAB, and then we know what finance brokers and mortgage brokers are. But you represent a company called AFG who are aggregators. So what do aggregators do, and where do they sit in this hierarchy of banks and brokers?
It's always a good one when I'm down the pub with the mates having a what do you actually do, Andy? It's an aggregator. Oh, what's an aggregator? I said, well, I suppose if you wanted to, what I would say to my friends is, well, say you wanted to become a mortgage broker, and they go, yeah, okay. Well, I said, then you would approach an aggregator. Oh, okay, what's that mean? I said, well, with the aggregator, we hold all the accreditations with all the different lenders out there. So AFG, we have some 90 plus something different lenders on our panel that we negotiate with and sort of host those lenders under the AFG banner. So when a mortgage broker starts out, they need to join with an aggregator. So the aggregator, essentially, it used to be, say, it's a middleman, between the lender and the broker. So the bank will pay the aggregator for any commissions that's written for a mortgage, and then the aggregator passes that on to the broker. In the last sort of certainly 8 years, aggregators and AFG, we're quite a large organisation. We're ASX listed. We have over 4,000 brokers in Australia nationally. Some quite big organisations as well. Some of them having over 30 to 40 brokers in their businesses. So we sort of supply them also with compliance. We supply them with technology. Everything, cybersecurity, data governance,
Training. Lots of ongoing training. Yeah.
A huge amount of training. Learning development is key, keeping their professional development up, and compliance is the main one as well. And part of the Royal Commission happening several years ago now, when it almost killed the broking market. It's just gone from strength to strength now, and I think the latest figures were that mortgage brokers now write 75% of all residential loans Australia-wide, which is called a third-party channel. And that's thanks to the professionalism of mortgage brokers in the industry, but also with aggregators really sort of getting involved. And when that Royal Commission was happening, lobbying the government, and actually, because a lot of people didn't understand what mortgage brokers were doing, and they certainly, to a lesser extent, didn't really understand what aggregators are doing. And it's fantastic to see now, because a mortgage broker is actually acting in what's called best interest duty. So they are actually acting in the best interest of their customers. Whereas the banks will really, they won't tell you that if you ring up, you can probably get a better interest rate. A broker will sit there with you and go through your loans and make sure you're on, or they should be, at least giving you a call every 6 to 12 months just to make sure that you're on the best rate, and interacting with you. So you can build up long-standing relationships, where if you've had a mortgage at a bank, or if anyone does on here and has a mortgage at a bank, I'd be certainly getting a broker to look over what current rate you're on. And then if the bank's not prepared to, or ring the bank and say, look, I'd like to get a better rate. What's the best rate I can get? Can I reduce my interest rate? If they say no, then definitely go to a broker and have a shop around and see what's out there. So that was a pretty long-winded answer, but I hope that sort of,
we love it.
Yeah.
We love it, Andy.
I get it asked all the time, and I should learn how to get it off to a T.
We like your pub answer. That's good, and I could talk to you for hours about finance and that. But that's a great kudos to AFG. There's probably, I think, 21 to 22,000 brokers, finance brokers, mortgage brokers Australia-wide. They are the biggest, is my understanding, 4,000 brokers in their network. Their head office is based in Perth, WA, so big kudos. And I think, from what I can understand, finance broking, the first brokers actually started out in Perth. And just a quick answer from you, Andy. How long have brokers been around? Because it's not that long ago where you wanted a loan, you had to go and sweat and beg with a branch manager at your bank. So
Yeah.
how long have brokers been around? Finance brokers, mortgage brokers.
Well, it was actually our 30th anniversary last year, and the founding members, I guess, essentially that's where mortgage broking started. The founding members here were, they were getting customers and introducing them to the banks, and as Garth said before, you'd have to go and negotiate with your bank manager, and that's essentially, well, hang on a minute, we've got all these customers, and we're introducing you to you lenders. How about you start paying us some commission for us to introduce you? And that's essentially 30 years ago. That's where the concept of broking really started, and that's where sort of aggregation started as well. So relatively young but
and that's what I'm sorry, Andy.
Where we've come in 30 years and where we'll be in the next, I guess, with technology now and AI. So I've seen it since I haven't ridden a loan now for probably must be about 6 years, something like that. And in that period, stuff's changed so much. The technology's come so far. The customer service has increased so much. The product selection is huge. Where we're going to be in another 5 years, I mean, I can see us being pretty much like the UK, where you wouldn't go to a bank to get a home loan anymore.
Yes.
So
yes. And that's amazing. In 30 years, from having zero market share to 75% now, and the trajectory going up. And the thing is, brokers are good because, and the ASIC that overrules an APRA, they like it because what they want is competition for consumers, and brokers bring competition, like you said, massive number of lenders on your panel and the brokers channel. So thank you, Andy. You were fantastic. There may be some questions at the end, so thank you. If you just want to mute yourself, and I will now introduce our next presenter, and that is Dana Reynolds. Dana, if you could just turn on your mic, and very warm welcome. Dana, I'm going to do a little introduction on you now. Dana is head of our property research and stock acquisition at Property Powerhouse. She does a fantastic job for us and has really brought some good energy and some great quality controls to the business. Dana has been in the Australian property industry for over 15 years now, and she has been an avid property investor, developer, renovator, and as a real estate licensee with a specialization in new developments nationwide. Prior to joining Property Powerhouse, Dana was the developer's master agent for the towers at Elizabeth Quay in Perth. So that's a beautiful development, and good kudos to her. As head of research for Property Powerhouse, Dana and her extensive team, our team, spend their time reviewing, assessing quality investment properties Australia-wide, searching for top quality, low risk opportunities for our clients. Over to you, Dana.
Thank you, Garth, and hi, everyone. Nice to be here tonight and have a chance to speak with you all. So as Garth's mentioned, as a property researcher, I spend most of my time scouring the market, looking at properties. So I feel very lucky. I love real estate. I love property. If you can go back to the next slide, that's fine. And just to get right into it tonight, we wanted to talk a little bit about why Melbourne and why now, because as you saw in the first slides, Melbourne still does have a downward trajectory. So why would you look at Melbourne? It is the fastest growing city in the country. That's a fact. And by 2030, it's set to overtake Sydney as the nation's largest city with the biggest population. And that's due to the fact of just a natural increase. There's more births than deaths every year. And there's huge interstate and international migration into Melbourne. Victoria as a state needs 240,000 new homes per year, but the supply is falling short year after year. So we're seeing a bigger gap in that supply and demand ratio. It's also more affordable than Sydney, Brisbane, Perth, and Adelaide. Yet it's got a really stable and strong economy, very diverse. It's historically the second most expensive city, as Garth was mentioning, and currently the sixth. And it has not experienced the growth that we've seen in the mid-sized capital cities. We expect this will push property prices higher over the future in the near term, medium term, and drive rental yields higher as well. So we're really excited about the opportunities in Melbourne. And if you can click to the next slide, please, Garth. This will show you a map of Melbourne, and some of the properties are shown by stars that are available right now that we've sort of cherry picked. Now, Andy was talking a lot about how no one has a crystal ball, and that's true. No one has a crystal ball, so we can't say what's going to happen. But if you want to get into the property market, you want to protect your downside. So what I do is I look at hundreds of properties every day and really look to find those golden nuggets, those properties that are safe, secure, low risk, that will rent easily, that will have very little maintenance issues, that you can count on being a stable investment, and you can sleep at night. So if, you know, this does span the price spectrum. Obviously, if you're buying right in the inner city, it may be over $1 million for properties, but we also have some amazing properties in the middle of the market and at the lower end of the market. Yep. You've just popped up, Garth. So did you have a question there?
Yeah, I like all these red stars. What do you find generally with Melbourne in your research, Dan? Are you finding like one area tends to be a more affluent, more expensive? When we're looking for clients that can, let's say, only spend 600, or ones that can spend 700 or 800 or can spend to 900, are you starting to see a pattern
Sure.
throughout Melbourne?
So historically, the southeast of Melbourne is the more expensive, more desirable market, or section of the city. I know in Perth, there's a divide between the north and the south, and everyone's really holds their own area very strongly. But in Melbourne, we really see a very big distinction where the southeast is much higher property prices, higher rents than necessarily you would see on the western side of the city, which is traditionally much more affordable, lower cost to get into the market. The inner suburbs, those premium, properties located within sort of 5 kilometers of the CBD are traditionally the most expensive, and the northern side is probably in the middle there in terms of values. That answers your question. And so running with the theme of tonight, I thought I'd talk to you guys about some of the properties on the lower end of the market that we've been looking at. And at the end of this, I would love some feedback, guys, if you like what we've done here tonight, sort of doing a deep dive into properties, and if you'd like us to do this again for you. But in the theme of lower interest rates, that really has a bigger impact on people who are buying at the lower end of the market. If you have $1 to $2 million to spend, one interest rate drop probably isn't going to make that big of a difference. But if you're struggling to get into the market, this is huge. So I thought I'd talk about some little gems that are really quite affordable. So what you're looking at is the 2-bed, 2-bath here, the little white ones in the center. They have 1 car park, and they are $527,540. So an amazing price point there. And we also have 3 beds not shown in this image, and those are $625,745. Now we talk about being low risk. Now, in part of the due diligence that I'm doing on every single property is making sure that the builder who builds them is a quality builder. I have, again, been in this industry for quite a long time. I've seen the gamut of properties. Some builders produce properties at the end that you are shocked by. And there's so many marks and dings and issues, and things aren't completed, or maybe they didn't include things. So we want to make sure that the builder is awesome, reliable. And when the property is handed over to you, you are always going to say, wow, on your handover inspection. And so the builder who's building this is a very trusted, reliable builder, and they do beautiful quality work. The finishes are fantastic, and every property that we've seen that's completed from them has no issues at all. So we really love them. The other thing about being low risk is that they're nearly complete. Now, the reason that that is great is because you know what you're getting when you're buying it. You know what your own personal situation is. Nothing's changed. You know where the market's at, and you know that you can get a loan. All of these things. So getting something that's nearly complete is more tangible than something that might be completed in 24 months, where things might change for you or within the world. So that's why I picked these to do a deep dive into. And I'll just sort of walk you through some of the research that we've done. So if we can tick on to the next slide, please, Garth. The location is called Werribee. This is a suburb that is 32 kilometers southwest of Melbourne CBD. It's an established community. It was established in the 1850s. So it's been around for well over 100 years, located on the Werribee River. It's got a population of 56,000, which is a nice, strong population, but it's expected to grow to almost 88,000 over the next 21 years, which is a phenomenal change in the population. So this is an area that Victoria has earmarked to house a lot of this population growth. It's a commuter town located right on the Princess Highway. It's got a town center. It has council offices, only a 30-minute drive out of the CBD. I thought this would be a good opportunity to talk to you guys about the Westgate Tunnel project, because this particular location, Werribee, is going to benefit massively from the Westgate Tunnel. A lot of people hear about it and don't really understand what it is. So the Westgate Bridge is the entry to Melbourne from the west, and it is absolutely at capacity. So traffic is bottlenecked from the bridge itself. And the Westgate Freeway is one of the busiest in Melbourne, often very congested. You may hear people say that travel times to the west can be really difficult because of these things. So the Westgate Tunnel project is not a single tunnel. It's actually a massive infrastructure upgrade stretching from the M80 all the way to the Westgate Bridge, and then it links onto all the major arterial roads. So it includes not one tunnel, but 4 tunnels, brand new express lanes running right down the center of the freeway. The freeway's being widened all the way through, and they're actually redirecting all of the trucks to the port, so they'll not be in that normal commuter traffic, and tons of new on and off lanes. So that's a really exciting project that's underway in Melbourne right now. And when it's complete, it'll ease congestion and access to the city from the west. I also wanted to mention that the primary driver of population growth in Western Melbourne is actually the availability of affordable housing. That is what's bringing people to the west as opposed to the southeast, because a lot of people can't afford to get into the southeast. It's attracting first home buyers, young families, and a really large number of the new migrants who are looking to get into the property market. So next slide, please. Now, just to narrow in on the map, Werribee is here on the left of the screen, and the properties are right at that dot that says Harpley, right there. You see there's a couple of train stations right there. There's the Wyndham Vale station, but there's also the Werribee Town Centre and Werribee train station right there. And that's a metro line, so quite quick into the city. It's also got one of the largest hospitals, Werribee Mercy, and Suzanne Corey High School is one of a few what's called select schools in Melbourne. This is one of the most prestigious schools in Melbourne, and you can't get in by paying for it. It's not a private school. The only way students can get in is actually by testing in. So a lot of people want to live near it. They want their children to go there. So it's a huge driver for the area. The purple line at the top is a train line. The green line is also the train lines. And if you can see where I was drawing in yellow, that is the Westgate Tunnel project. So it's massive, stretching all the way into the city from Altona. All right, next slide, please. So the houses that we're looking at are located in a state called Harpley. This is what the town center will look like. The lake is already built. They're just working on the paths and the landscaping at the moment. The shops are all built. This is an estate by a developer called Stockland. Many of you may have heard of them, but they are one of the best land developers out there. They do beautiful master plan suburbs and are really trusted. So we always love to be in Stockland Estates because the streetscapes are lovely at the end. Next slide. And just to give you some information about the estate, so digging in a little bit deeper, it's a 435 hectare master plan community, so quite a large footprint. It will house 12,000 residents or thereabout on completion. It's 3.5 Ks from the CBD of Werribee, 35 Ks from Melbourne, just a 5-minute drive to the train station. They've got bus links, they've got this Ison Road rail overpass proposed, which will help ease travel times, and a number of really good schools and childcare facilities in the area. Next slide, please. It's also got the town center, which is underway and partly up and running. 7-Eleven, McDonald's, Kohl's, they got medical centers. They're going to have pharmacies, gyms, offices, cafes, shops, etc. So everything that you really want in your local community. It's also got a ton of open space. So about 23% is earmarked for open space, 60 hectares of waterways, 15 hectares of sporting fields, 9 hectares of parks and gardens, hiking, bike trails. And Stockland is also committed to sustainability. They're committed to a net zero carbon footprint from their development. So this is all lower energy streetlights, fiber optic connections to all home, recycled water systems for toilets and gardens, and has that 6-star green star rating. So that's all great things that we like to see looking towards the future. So next slide, please. Looking deeper at the location. Well, I'll first take you to the small pictures on the right. On the bottom is the entire master plan community. So that's giving you a sense of the scale of the estate itself. The next image up, we're sort of looking at a little bit more zoomed in, and you can see the waterways running to the right side of that red patch number 20, which is the town center that you're looking at on the left. So on the left, we're really zooming in on that town center. This is where the lake is. I don't know why the lake isn't pictured here, but it's right in the center in the pink area. That's where all the shops are going to be. The primary school is going to be. You have playgrounds already up and running. You've got the parks already. So it's a really buzzing little pocket of the big estate. And the 2 houses that we are talking about right now are just about 150, 200 meters out of that town center where the red stars are. Both sitting right near this little central park. So yeah, all on green space, green outlooks, which is lovely. And just next slide, please. So we actually look at the floor plan. I love this 2-bedroom house. This one makes sense to me every day of the week. It obviously has a bed on the ground level with a walk-in robe and an ensuite. Also on the second level, it's got a nice open plan living, a 2nd bedroom, bathroom, and a balcony. And this property looks out over a park. So it's actually facing onto the park. The balcony looks over the park. The front door faces the park. So that's green space that will never be built out, which is a fantastic thing. It's expected to rent in the range of $440 to $470 a week, and there are no body corporate fees. So that's really great. And then next slide will show you the layout of the 3-bedder. Click down. This one has 3 beds, 2 bath, and a double garage. Slightly bigger footprint, expected rent of $460 to $500 a week, also no body corporate rates. This one is not facing over a park, so that's a little bit different, but it has a great balcony. It's got a study nook, it's got a nice kitchen, big closets, reasonable sized bedrooms. So these are all the things that we're looking for in the layout, just that it's really a livable space. And so after I've kind of gone through the layouts and I'm happy, there's no funny things like no bathtub in a family home. So I'm always looking at the floor plans to say, well, that makes no sense, like a bedroom with no bathroom on that floor. But these really, they're quite sensible designs, so that makes me happy. And then when I move on, I start looking at all the inclusions to make sure that it's really a fixed price turnkey package. Meaning it's completely rent ready and has absolutely everything. So instead of boring you guys, I thought I'd show you a video because this builder happens to have a video of these house or of display houses, which are virtually the exact same plans. So this will give you a good idea of what these floor plans would look like in real life. These are not in Harpley, they're in another estate in Mount Atkinson, but they're already built. So if you could play that for everyone, Garth, please. I'm not getting the sound. Oh, apologies, guys, that there was no sound there, but that does give you a good idea of the level of finishes that you would expect. Um, and yeah, that's a type of property that ticks all of the boxes that I would sell to my mom, that I would buy every day of the week. And thanks to the interest rates dropping, maybe I'll be able to.
Awesome, Dana. Thank you very much, and thanks for giving a little bit of insight into what happens in the property research team and your day-to-day stuff. So great opportunities there out of Melbourne. Thank you for sharing, and apologies for that sound. It was working my side, so I was busy singing along. We've got a call in from Rufi regarding the land size. We can send you some information on that. As you can see, they are Torrens title, Greens title, but they on smaller footprints of land, been sort of like a townhouse built, but that's what makes them affordable. So, Rufi, happy to send that information through to you. Is there any other questions? I'm mindful of the time, so we've done very well with time. We're just 1 minute over at the moment, but do we have any other questions for finance or for for Dana on the research side? We've got the great news is we're always looking, always traveling to look at property. So our team is heading off to Adelaide for a couple of days next week, and then spending some time in Melbourne next week as well. So going to that property, going to some beautiful suburbs like Essendon, going to suburbs like Sandringham, where we have buyers already in those markets. So making sure we've got hands-on, really seen it, touched it. The more affordable Western corridors, those inner, more expensive suburbs, and the beautiful southeast. So great opportunities there. I don't think there's any questions from anyone else. I will send out a recording from tonight. I think we've had some great presenters. So thank you very much to Andy and to Dana. The call to action from this is interest rates are down and coming down. Get hold of your finance broker, please. They need to be your best friend for this next year at least, and maybe the next couple of years. As interest rates come down, do not become complacent. Please don't become lazy. You work very hard for your money. Let's make sure that you're getting the best loan at the best, most effective loan that you can. Not always about the cheapest interest rate. It's about getting the right loan. So talk to the brokers. They are super people. They're like superheroes in my eyes. They at no cost to you. They really care. There's 22,000 of them around the country, and they are taking up 75% of the market of writing loans. They can come and see you at your own home if you want. They can do an online interview or questionnaire if you want. So please reach out to your finance broker in the next couple of days and let them know that you just want to get maybe it's time to get your house revalued. If you live in Perth, Adelaide, or Brisbane, you're sitting on great equity. Talk to the broker. Let's have a look. What's the current value of your property? Do you have equity? Do you have serviceability? If we wanted to buy an investment property, could we do that? I'm not saying you have to or you should, but just knowing what your options are. So get hold of your finance broker, mortgage broker. If you don't have a trusted partner for that, you don't have a trusted finance broker or mortgage broker, please reach out to us. We have a big network Australia-wide, and we could introduce you to one or two or three. And it's really important that you get on well and you trust the person that's looking after your finance. So get somebody, work with them, make sure they're keeping in good contact and looking out for your best interests. So thank you very much for all being on there. I hope there was, even if you've learned one thing from tonight, then it's been worth your while. The recording will come out within the next 24 hours. Thank you again to